Hey, everyone. It is the Tuesday before Thanksgiving. And hey, thanks for everyone for watching last week's video. And that's the best number of views I've had for a video within a 1 week span in a very long time. Thank you, thank you, thank you. Deeply appreciated. And this week, as promised from last week, I said I would go into a small cap stock. And if you're wondering why a small cap stock, then we'll watch last week's video. I told you about how this very extreme thing that is currently present in markets, which is all the money pretty much is in big stocks. And if history is any indication, if my knowledge is any indication, my experience is any indication, yeah, when everyone's on one side of the boat, yeah, you know, the future gains are going to be on the other side. But before I go into this week's stock, and you know what, I was going to do like 3 different stocks, etc. But instead, I picked a really small stock, right? Really, really small, a $20 million stock that, in my opinion, is like really could rocket up. And I'm going to try and do actual analysis for you on, yeah, I mean, essentially trying to go back and forth between the camera and the screens. And of course, the sun is like right behind me, so like maybe I should stand up. But before I do all that, all right, let me do the disclaimer on this like, wow, yellowed out sheet. Whoa. Yeah, okay, get down here. All right, this video and all the content from my company, ATG Digital Media, is not financial or investment advice. Past performance does not equal future results. Errors, mistakes, oversights, yeah, they happen. Capital loss is a likely and potential outcome you should consider before you put your money at work or at risk. I, the owners, contractors, employees, associates of ATG Digital Media, it's my company, own, trade, and transact in the investments that are mentioned in this video, in our model portfolios, in our updates. What else? All Man Speculating podcast. I haven't done one of those in a while, but I have lots of ideas. Just got to get to it. Pretty much any of the content that's put out, X Post, Instagram, Facebook, etc., etc., etc. You're wondering how to go and access some of our content, a subscription, or just check us out, atgdigital.media. That's where we are. Paid subscriptions begin at $9.99. We focus exclusively on innovation and growth because it's very clear to us that that's where the world is and is going. So it makes very little sense, when we think, what will people wish they did, looking backwards, 5 years from now, 7 years from now, they're like, oh my gosh, that was so obvious. That was so clear. Well, hey, we want to be doing that now. So we think we want to be in innovation and growth. So we're in stocks, crypto. You get picks, which go into our model portfolio. It's up to you if you want to follow us, follow part of us, do whatever you wish with what we provide. We do updates, and then we have market strategy commentary, which is part of those updates, and then also company and crypto updates. And if you kind of want to get a taste for what it all looks like, we provide a free Substack, which is at paulmanpilly.substack.com, where there is actual company analysis. I tend to write a lot about macro, but my other team members, they write about individual stocks, giving out really our thinking and how we go about sort of like seeing the world, how we look at companies, what is going on. But today, for this video, I want to focus on one company, all right? Okay, and this is a tiny, tiny, tiny company. How tiny? 20 million market cap. You're like, well, what is this market cap, Paul? I understand stock prices. Market cap is when you take the number of shares and you multiply it by the stock price. Remember, a stock is a representation of a company and its ownership is divided into shares. So the stock price essentially is you take the value of the company and you divide it by the number of shares, and that's how you get the stock price. So if you want to determine the size of a company, you look at market capitalization, not the stock price. In this case, you got 20 million, which is tiny. For context, Apple is a $3 trillion company, 3 trillion. Yeah, 3 trillion. That might as well be like another galaxy compared to this company at 20 million. Now, hey, I want to be straight up. Smaller companies, despite everybody thinking like, hey, these are great, they're riskier, they're less likely to work out. However, if they work out, potentially the gains can be high, which is why people and I and anyone else are interested in them. But you have to understand that the risks are higher, the probability is lower. But potentially in success mode, yeah, I mean, you can make a lot of money, and that's what we focus on. This particular stock is in our diamond tier portfolio. That is one of the highest tiers. And I'm focusing on such a small stock because, number one, I feel like this stock is ready to take off. That's my sense and my feeling. That's and so I want to put that to you. Second is that these micro caps, because I mean, a $20 million market capitalization company, right, is this is like a very small ant within even the ant world, right? I mean, if Apple is like the biggest elephant, I mean, we're talking about an ant that's small in an ant world. So this is really tiny. But thing is that with a small amount of money, right? I mean, 20 million. So someone to buy 10% of this company would take $2 million. 2 million. I mean, we've got people with hundreds of billions of dollars in their net worth. We've got people with hundreds of millions of dollars in net worth. Even for them, it would be a fairly small investment. Bottom line is that a small amount of money can really start to push it up, as long as there is a real and true investment case for it. Because really, since I'd say about the beginning of this year, it's become very clear that the old bull market, where pretty much, a lot of stocks could go up all at once, they could be based on speculative demand, that's over. Today's market, you need to show growth. You need to show you have some pathway to sustainability, profitability, positive cash flow. You got to show that. In other words, there's got to be something that's already there, something that's unfolding right now. And third, you got to show that you're not issuing shares like water. In the previous bull market, people could pay, people in options, and all those options eventually get sold into the market. So it devalues the stock, it dilutes the stock. Those are the three things that I'm seeing that matter. And not every company has to meet all three of them, but you have to get sort of like a general picture that these three things are either in place or setting up to be in place, so that as money comes in, there's not sellers. As money comes in, there is a series of, events, but I'll say like news that confirms like, hey, this company is cheap, this company is valuable, and that will continue to drive the demand cycle. Okay, enough generic stuff. And let me now go to share my screen and tell you about this company. So, all right, you should be able to see that the name of the company is Ekso Bionics. The ticker symbol is EKSO. So if I scroll up, you can see this has been that chart. Yeah, that's like the maximum, in other words, since it came public in 2016, this has been an unmitigated disaster of a stock, right? Look, it's lost 98% value. So like, hey, like, you might be thinking, wow, this must be a piece of crap. But hey, listen, stocks can turn around, and it's generally in environments like this where nobody owns it. It's been sold on hard. There's been good news that has been ignored because of liquidity. What's liquidity? Somebody just wanted to get out of the stock, and they're like, hey, here, take it. I don't really care what price you give me. I just want out. And usually after that, the sellers are wiped out. And then whoever owns it, maybe it's market makers, maybe it's someone with a lot of conviction. It may be really like, all of us as retail investors, people who know the company are like, hey, this company should be bigger. It should be higher. Maybe it's not the greatest company on earth, but nonetheless, it really shouldn't be a $20 million company. You see that? That's the market capitalization. 20 million. Shouldn't be a $20 million company. All right. So let's just look at a few things here. I mentioned what the market is focused on today. I said growth. So let's look at growth today. So I'm just going to go here. And in case you're wondering what I'm using, you can see I'm using a platform called YCharts. Sure. So let's look at this. So this shows you the last 1, 2, 3, 4, 8 quarters, and you'll see under operating revenue here, last quarter, which was quite recent, we reported 38%. The previous quarter, 39%. The quarter before that, 60%. That's their seasonally strong quarter, along with the last quarter of the year. So growth, yeah, I'd say they've got growth that's going. And I will show you in a few minutes why there is a catalyst that can actually surge this growth even higher, and definitely at the very least continue this sequence of, I'm going to say 25, 30% growth for some number of years, in my opinion and in my judgment. All right, let's look at a couple of other things here before we get to some of sort of the news as to why now. How much cash they have? Well, I mean, hey, it's a $20 million company, so they don't have like $100 million in cash. They've got what, a little bit under $10 million in cash. So they got enough money to to get by. What about profitability? Well, they're not profitable yet, and I use the statement of cash flows to look at it, because companies are always trying to be like, oh, adjusted EBITDA and this and that. I'm like, no, cash from operations you show. So we couldn't compare it to the last time they did this. I mean, last September, and you can see they lost 2.6 million in September of 2022, and now they're a little bit higher, but they have a reason to be slightly higher, and I'm going to get to that, which is that they made an acquisition which would require them to have slightly higher expenses that I believe, in my judgment, is big enough to pay off. All right. The last thing we want to check on that I mentioned, remember I mentioned they have to have growth. They ought to be on some pathway to sustainability, profitability, positive cash flow. Now, I know that they showed negative, but I haven't gotten to the catalyst that will point to it. And the number of shares, I mean, hey, I'm trying to get down to where it is. I got to change the setting here. The number of shares is not going up. I mean, it's gone up slightly. You can see here 13.6 million in June of 2023, and now at 14 million. That's approximately flat. And then if you go look back a couple of years, it's at what, 13 million. So they've, relatively speaking, behaving themselves, right? I mean, so just to sort of do a roundup. So the stock that's in question here is Ekso Bionics. And what do? Well, they make exoskeletons. What's an exoskeleton? It's a little bit like a automated, roboticized brace, and it would be used by people who have lost either ability, strength, control of various limbs. It's a sort of a very specialized piece of equipment. Its use is primarily in healthcare, but there has been some, I'll call it experimental use by sort of industrial users. For example, like auto companies, trying to take the stress off workers, because we'll assign them an exoskeleton. And the idea is to take the stress off your shoulder, or stress off your spine, and things like that. So it does have wider applications that right now, I mean, I'd say they're in very, very, very nascent stage. All right. So right now, though, the play definitely is based on healthcare. All right. Let's go back to some things that I want to show you again. So this is the chart of Ekso Bionics over the last 12 months. And you'll see okay, what? In February of this year, this was at $1.80. And then this thing just crashed down. And in my opinion, my judgment, this is like a liquidity-driven crash. In other words, nothing really changed that much. The company actually, in my opinion, things were actually getting better at the company, yet somebody just wanted out, and so they sold. And once they were done selling, and I told subscribers of ATG Digital, I was like, listen, when this selling's done, you're going to see the market makers, whoever controls the market, the moment the selling's done and they get it, they will mark the price up immediately. And that's what happened. You can see here, it went from what, 62 cents back to $1.50 in almost no time. Okay, sticking to charts, looking at it on like a, this is a 5-year chart using 1 week instead of like daily. And you'll see like what, so it went from like 62 cents to $1.50 in a few weeks, but then you'll see like there's all this open space above there. Now, I'm not the biggest one on technical analysis, but I have definitely, I'm definitely versed in technical analysis. And what people would say is that there's almost like there's very little overhead selling. Why? Because the person who wanted to get out essentially cleared out sort of like all the sellers for like a very wide range. And that means that as buyers come in, there's no sellers, or whoever controls the stock is willing to take that stock in to ensure that the uptrend continues. All right. I know that sounds a little vague, but essentially these are called like market making operations. If somebody wants to sell and stop a downtrend, if you own enough of the stock, it may be worthwhile for you to just take that stock in other than have it interrupt the uptrend. Some people might see as a kind of manipulation, etc. But hey, that's the way the markets operate. It's the way all markets operate. All right, very quickly, so I get back on camera. I told you that there was like a very positive event that actually happened. It happened at the end of 2022, which is that suddenly out of nowhere, the company announced that they were getting to buy a really mature technology from a much larger company called Parker Hannifin. Parker Hannifin is a really large industrial company, and they clearly had hopes and aspirations for this exoskeleton business, for their industrial business, and they decided at the end of 2022 that they just wanted out. It wasn't probably scaling fast enough. It was too small, wouldn't really make a dent in terms of their finances. So they sold it. And in my opinion, Ekso Bionics got it for a complete bargain. $10 million for a business that Parker Hannifin probably put, I don't know, 30, 40, 50 million in to be handed. Yeah, that's a complete gift. All right. So now they've strengthened their business and they've bought into this business and they've paid $10 million, which I think in hindsight is going to be seen as an absolute steal. The next thing that matters is very recently on November 2nd, Ekso Bionics got this very important piece of news, which is that the Centers for Medicare and Medicaid, which essentially is the part of the government that administers Medicare, which is this enormous hundreds of billions of dollar program that reimburses for all kinds of things. They've agreed now to include Indego exoskeletons under the coverage for braces. And you might be thinking, braces here? What's that? No, braces like for your arm, for your back. Yeah, I actually had a screen up to show you that. So what's a brace, for example? Well, it looks something like this. Yeah, I mean, as you can see, I mean, a lot of them are used for knees and things like that. So previously, Ekso did not have that coverage. And without that coverage, an exoskeleton is too expensive. There's no way that a person is going to, in all likelihood, pay for this out of pocket. So reimbursement really lights a potential fire underneath the sales of Ekso. Now they've got their original platform, and now they got Indego, essentially a second product set that can lift their sales up. As their sales go up, if they can keep their cost basis approximately the same. Now, I showed you that their profitability was slightly less, but that's because they also have a new platform that they have to support. But Indego, I mean, how much could it generate? If it can generate 5 or 10 million a year, I mean, that will triple, quadruple their sales. And if it can go on for 3 or 4 years and get Ekso Bionics to generate 15 million, 25 million a year, yeah, I mean, this stock is at 20 million. right? 20 million. So a growth company is usually valued at 5 times sales, 7 times sales, 10 times sales. In the peak of its growth, if it can show profitability and it's well behaved in terms of the number of shares, I mean, hey, this is a tiny company, it's illiquid. Yeah, I mean, this is the kind of stock that can absolutely shoot higher, even in this market where people are a bit skeptical, etc. So what's the bottom line? Bottom line here is that, number one, the takeaway from the last video, which is that small cap stocks, yeah, I mean, they've been so destroyed, so utterly, like, just crushed, that there's going to be a snapback. And the snapback, of course, is going to go into what the market currently values, what the market currently wants, and that's growth, sustainability, profitability, whichever one you want to talk about it. And it's got to be like where shares are still scarce. You cannot be issuing shares like water. And then for that, hey, here's a company that's valued at $20 million, made an acquisition for a potentially large project that can really double or maybe triple their sales, which would give them profitability into the future. And as long as they keep their shares fairly well behaved, I mean, there's going to be scarcity. So we got the recipe for growth, we've got the recipe for profitability, recipe for demand. So that's it. Ekso Bionics, ticker symbol EKSO, market capitalization of 20 million, stock price of what, about $1.50. Where could it go? Hey, you can let me know. All right. Hope you liked it. Come back next week. All right. This is Paul saying bye.